RBI Governor Shaktikanta led Monetary Policy Committee is huddled on Mint Street for its 3-day policy meeting. The outcome is scheduled to be announced tomorrow, and market watchers will be eyeing the governor's revised economic projections and the interest rate trajectory. The fact that global backdrop has deteriorated significantly since the last MPC review in February is already priced in by the markets. Higher food and oil prices due to the Russia-Ukraine conflict and a hawkish US Fed too have been absorbed by market participants.
I think market seems to be a tad mixed with regards to where the rates and policy stance is going to be in the upcoming policy and the policies ahead. We are not looking at the RBI changing the policy rates in the upcoming policy and probably in the following policy as well. Nor are we expecting them to change the fixed reverse repo in this current policy, which is due on April 8th. Our sense is that while the economic slack seems to be a little worse than what it was say a quarter ago, inflation uncertainties obviously have increased, and that is why I think the market seems to be a little mixed in terms of where they're seeing the rate stance and the policy stance.
Yet, this discounting of information doesn't make policy setting easy for the RBI. There are upside risks to inflation, downside risks to growth, and an uneasy balance of payment scenarios staring India in the eye. Thus, it is the commentary of the governor that will be watched by Dalal Street on April 8. According to Radhika Rao of DBS Bank, evolving risks are expected to challenge the RBI's view on FY23 inflation, prompting a 50 to 100 BPS upward revision in the CPI inflation forecast. Growth risks are likely to be highlighted as a result of weak run rate in India's third quarter GDP and global headwinds. Rao says a change in stance from accommodative to neutral will signal a readiness to switch policy gears in the coming months, but a subdued growth view might keep the MPC from an imminent shift. But the street could be in for a negative surprise if the RBI's revised projections are worse than what the market expects.
The crude oil prices, which is extremely important for India, they have been above $100 per barrel for almost a month now. So I believe there will be an upward projection. There will be an upward revision in inflation projection. What would make it jittery for the markets? I think the market consensus is somewhere around 5.5% as far as inflation is concerned. So anything above 5.5% from the RBI on inflation front would worry the markets. At the same time, if we speak about GDP growth, again, the RBI, the market consensus is anywhere close to 7.5 to 8%. So if RBI revises its growth projections downwards to 7.5% or lower, that will be worrying for the markets.
Meanwhile, bond markets are pinning their hopes on the central bank stepping in to manage bond market liquidity at this week's policy review.
I think two things. One would be change of stance, if at all any. And if there's no change of stance, is there an indication towards a change of stance? Because that would imply that the OIS market, would probably start pricing in a much tighter policy. They're already pricing in a rate hike, before August. So there could be a repricing in terms of rate hike. One and two, we clearly have a very, very heavy borrowing calendar for the year, of which 59% of the overall borrowing will be borne by the first half. And, amid the demand supply mismatch that you may see in the first half, I think RBI will somewhere have to come out with, an open markets operation support, which will sort of give, some cushion to the yields. But I doubt they would be coming out with a very explicit GSAP calendar that they did last time, largely on account of the fact that, they still have the same inflation growth dilemma and the fact that they might, over the next 3 months or so, be changing stance and even, going in for parallel policy actions. And with that in the backdrop, if they come out with an explicit commitment of GSAP or OMOs, that could probably go against their monetary policy stance. So I think they will probably tactically intervene in the bond market in the next 3 to 6 months period, while also moving crawling towards a stance change, not immediately, though, but will prepare the market.
Overall, the RBI is expected to extend its unwavering support to growth during its first bi-monthly monetary policy of FY23. But if the global backdrop continues to be challenging, domestic policy setting would involve trade-offs.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.